Hi, John. Good to see you this morning. We're recording this on the first day of February. After markets have had another good month, so on top of the excellent and extraordinarily strong November, we had a strong December, and now we've followed through with a pretty reasonable January. In fact, in the last week of January, numerous stock market indices hit all-time records, including the S&P 500. John, what's going on? Why are markets suddenly so confident?
Well, there's a long-term relationship between the long-dated bond yield and the equity market earnings yield, and it's almost like it's a revelation to many commentators, and I guess it's because they haven't been in markets for as long as you and I have, Paul, which is obvious from our lack of hair. When bond yields rally to the extent they have, and we can question whether that rally is sustainable or justified, but the fact is when the bond yield comes down, the earnings yield comes down and the PEs go up. And so we've had, I think in America, to be fair, there has been earnings growth as well as PE expansion, particularly in that top end of the market. In Australia, we've had that PE expansion, and we'll find out in the next 4 weeks, I guess, how much earnings growth on top of the PE expansion is in the share prices of movements. But it's as simple as that. And I think it's what we said, months ago, that as the inflation rate came down, the bond yields would come down, real yields would come down, and there would be a knock-on effect to risk assets. It's as simple as that. And all this writing back and forth in the papers every day, opinion pieces, that's all investors need to know. Now, the next point is what's going to happen in the future. And of course, that becomes a basis of some macro thought based on what we're seeing and looking forward to how much of the price movements in the equity market it takes them into fully priced levels or not.
Yeah. Thanks, John. Just to put some flesh on the bones, I know the figures for the S&P 500, the PE for the next 12 months, prospective PE, bottomed at 15 in October last year. Today it is 20. So obviously we can see that PE expansion. Not quite sure what the figures are for Australia, but I think it's somewhere similar in the sense that it's probably moved up from, I don't know, perhaps 13 or 14 to somewhere around 16. John, two big pieces of economic data came out last week. The first was US GDP growth was stronger than expected, 3.4%. So obviously the US is growing pretty strongly. There's no more talk about recession. It seems like they've accomplished the soft landing, and you're actually seeing it in corporate earnings as well. And then the other piece that I'd like you to focus on domestically is the CPI that came out yesterday, and the number was lower than expected, which is certainly good news, and the market reacted by bouncing about 80 points. Perhaps you could tackle those two bits of data one at a time.
Yeah, well, look, on the American growth situation, I mean, it's always good to compare the budget deficit to the economic growth figure. And what you're outlining there, Paul, is that the American budget deficit of circa $2 trillion, or about 6% of GDP, is supporting economic growth of 3 to 3.5%. So there's a negative created between how much the government is spending and what sort of economic growth. In Australia, our growth is sub 2%. That's what's forecast, but we're running a budget surplus, which is quite extraordinary. We're looking at a surplus of between 0.5 and 1% of GDP, and we're getting growth without support from the government budget or fiscal policy. So that's the context. So when people talk about growth in America being surprisingly good, they've ignored the fact that the American government debt and fiscal stimulation is extraordinarily high. So in bland terms, Australia's growth is much more impressive. And the outlook for Australia's growth is good again. As I keep on saying, in 2025, when the immigration filters through the economy and starts working its way into production and consumption and income taxes. So I'm comfortable with that. Now, just reverting back to China, yes, they're not growing at the rate they thought, and it's a bit of a thumbsuck. Are they getting 5% or not? But they're not running a 6% deficit to attain the growth they're getting. They will probably substantially increase their deficit, Paul, as they try to bail out the property sector. But so be it. And being critical of China bailing out its property sector to the same extent that the American government is growing its deficit to support American economic growth, I think the argument loses support when you think about it more logically. So the Australian share market, even though it reached a new high yesterday, you've got to go back to 2007, and we're only about, I think, 5% above the index level of 2007. So it's not. I think there's a lot more momentum potentially in the Australian share market going forward than the broader American index going forward. The leading part of the American index is another point because they're multinational companies.
Obviously, a big part of the American rally has been the so-called Magnificent Seven, which are the mega cap technology companies, which are certainly absent in Australia. In Australia, our market seems to be led by the big banks, and Commonwealth Bank comes to mind. I was looking at the fundamentals yesterday. It's now on a PE of 20 and a dividend yield of 3.9%. You probably have to go back a long way to see one of the leading banks priced so expensively. How does it advance from this point?
Well, I take the point. There's a lot of investment money looking for a home, and because interest rates in Australia, and you've only got to look at the inflation number, Paul. Our inflation is coming back or recorded in low fours. Won't be long before it's in the mid threes. In fact, the last 6 months annualized is, I think, about 3.6%. If you take the last 6 months and double it, so it's on a very clear trajectory down, and we've been talking about this again for months. So we're about to see real cash rates appear, but real cash rates in America are in excess of 2%. In Australia, I'm forecasting they're about 0.5% real forecast, not today. So that leads us into, well, there's a mad scramble for yield. I published a piece in the AFR, which we may attach to this video, I hope. There's this mad scramble for yield, and the Commonwealth Bank shares are one of the recipients of that mad rush for yield. 3.9% franked gets you above 5%. And that's a growth yield. It's not a static yield. It will grow as the Commonwealth Bank grows. So there is justification on yield, if you think it through, why the Commonwealth Bank is rallying. Now, your other point is that fair value. Well, that's where it gets a little bit more difficult, I don't like seeing banks on big multiples. But you've got to also be conscious about talking PEs. I never like looking at historical PEs because that's gone. Current PEs are more interesting, but certainly projected PEs, that's what the market's buying. And I suspect Commonwealth Bank's PE will dip down as it grows in the next couple of years. But, you've got to be careful after such a rally. Absolutely.
One of the other pieces of news that came out this week is finally the declaration of bankruptcy for Evergrande, China's biggest property developer. Does this concern you? Is there going to be a fallout for Australia? Are our commodity export prices sustainable if China's going through a real estate crisis?
Well, look, I think you've got to buy the recovery. I mean, the bad news is well baked into the market. I guess this company has been limping along for at least 2 years, Paul. We've been waiting for the announcement of wind up. You would expect that the administrators and the administration of China have done a lot of planning before they pulled the rug on it. Maybe the smart money has got out. I don't know, but everyone's going to take a hit. Is it going to affect the economic outlook for China in a perverse way? It'll probably benefit it because the bailout and the government or administrators stepping into the shoes of that property company to complete projects means there'll be more certainty about completion rather than uncertainty when it's a semi-private company who's running out of money. So the government won't run out of money in taking it over. It's only a decision by the administrators what projects they want to take over, what they want to share with the private market, and then whether international investors dare come into the market to support it as well. So it's yesterday's news, Paul. It gets headlines, but it's been well managed, I think, over the last 2 years. And have a look at the result yesterday. The market just yawned to it, said, okay, well, that's not news. And particularly the Australian market was more focused on inflation than it was about Evergrande. Now, not saying it's not a bumpy road, and you can't be too cocky about it, but you know what's going to happen. The Chinese administration is going to come in at various levels of government and support the restructure of that company in some form.
Yeah. John, another item in the news over the last week has been the killing of 3 American servicemen in a base in Jordan, and they've pointed the finger at one of these Iranian proxy groups that's operating out of Iraq, I think. Iran has been a destabilizing force, supporting Hamas, Hezbollah, and now the Houthis. And the Houthis are interrupting global shipping through the Red Sea. We're now sitting on tenterhooks waiting for the Americans to respond to this, and hoping that this doesn't create further regional violence. The risk is that the Iranians could cut down on oil exports, or oil shipments could be interrupted, which creates an oil price spike, and then that sets back the task of lowering inflation for the developed world. How do you see that risk? Is it something that you can hedge against? Is it something that the market's already aware of? How do you see that risk?
I always make the comment when we're talking about it, the market's aware of it. So,
yeah.
So look, you got to look at the dynamics. America's moved quickly to self-sustainability in oil and energy. We've written about that, talked about that in the last month or so. So they're watching with interest. The biggest buyer of Iranian oil we know is China. China is playing a very covert game here. They're not actively, openly supporting anyone. But I think the message will come from China, probably passed on from America. Pull your head in, because it will get out of control. And the biggest loser will be China. At a time, as we've just discussed, when they can't afford to have any supply of oil or inflation issues going through that economy. So I think what we read in the papers and what's going on behind the scenes is there's a mile of difference. In terms of the attack, I mean, I'm no expert, but it seems that it came out of Iraq, funded by Iran. That's what they're all saying. If anyone thinks the American intelligence, the American army can't obliterate these people by targeted bombing, they're kidding themselves. So if I'd be hiding 100 miles, I'd be trying to get 100 miles away from where that drone went off. You know, they probably know exactly who they are now. So, look, this is what terrorists do. They do stupid stuff, and they have no concern about what the repercussions are. And I take the point. We should be concerned about it, but not worried about in terms of investing.
John, we'll have to finish off, but one last question. The RBA, the market is saying is finished raising rates and will now be thinking about lowering rates. What's your prediction? When will that happen? Presumably, it'll take into the second half of the year. Is that what you're thinking?
Well, it all depends on inflation. I mean, the American central bank last night said no more interest rate increases, effectively in their dialogue. They talk in double speak, but that's what we think they've said. So no more increases in America. They're sitting at 1.25% above Australia, give or take. Cash rates, their inflation is below us. Yeah. I don't see Australia cutting interest rates before America does. I don't think America's going to cut interest rates before March, April. So I'd say we're 2 or 3 months behind them. So I don't see anything in the next 6 months.
Yeah.
And that's as far as I want to go. I mean, we didn't put up interest rates fast enough. The government didn't do enough on inflation fighting, and we've got to work our way through the next 6 months to try and get over the inflation hump, which we're well over, and then settle it down around 3%, if not lower. And then you'll start seeing interest rates. But they're not going to come down to where they were during COVID. So let's not get excited. They probably will come down to in that 3.25%, 3.5% level, and that's 18 months away.
Yeah. Okay, John, thank you so much for that. An interesting discussion as always. And to our audience out there, we'll see you next week. Thank you.
Thanks. See ya.
Cheers.